Welcome, everybody. I'm excited you've all joined me this evening. This is a topic that I am super passionate about, how to achieve financial independence and financial freedom through passive real estate investing. I will share a bit about my journey that my husband and I have been on the last 5+ years as we kind of go through here. But before we really get into the meat of the content, as with any webinar discussion, when we're talking about potential investment opportunities, we need to first talk about the disclaimers. So keep in mind, this is for educational purposes only. As I mentioned, I'll be sharing a lot about my experience in the educational process that I've gone through and what I've learned through my own investing experience firsthand. I am not an attorney, a tax professional, or a CPA. So please consult your own individual attorney, CPA, and tax accountant for your unique situation. Everybody has a unique situation. So please do that. And also, this webinar does not represent an offer to sell or solicitation to invest in any particular deal that I may be a part of. So just want to keep that in mind as we go through it. But as we get started, let's talk a little bit about who I am. My name's Kelly Iannone. You've probably seen me out and about on LinkedIn is where I'm most prominent, but you'll see me in other platforms. And some of you I know personally, being neighbors or coworkers. So I am, in addition to all these other things that we do in our lives, I am founder of Waypoint Commercial Investment Partners, which is a boutique multifamily value-add investment firm. We do value-add multifamily syndications. My husband and I, we started investing in real estate about 5 years ago in 2017, as we were going on our own path to achieving financial freedom. And we've had the opportunity to build our portfolio to over 400 units spread across Florida, Georgia, and Texas. And it's currently valued at over $45 million. And we have an additional 202 or 242, give or take, units in the pipeline, as myself and some of my business partners were continuously investing in new opportunities and evaluating them. I do have 18 years of corporate experience with the Walt Disney Company in a variety of roles, from business strategy to finance to integration, which really lends itself well in my role as part of a syndication team, which really is a team sport. So it gives me an opportunity to plug into multiple different areas where I can be most effective. And then finally, again, I mentioned this is a topic that I'm very passionate about. I am a huge advocate for the financial independence retire early community, also known as FIRE. I truly believe that each and every one of us has an opportunity to achieve financial freedom in 10 years or less. And so we'll talk a little bit about what that means, but I truly believe that we all have the ability to craft a life that can be financially independent and give everybody the opportunity to take control of their time and really follow passion projects. So that's a little bit about me. And as I mentioned, I'm an advocate for the FIRE community. And you may be wondering kind of like, what are we working towards? Like, what's the goal? Why achieve financial freedom? It means different things to different people. Some people, it is just, how do I solve for retirement? Other people, it's, I just want additional disposable income. And then for many, especially if we're talking early retirement, it's really about, how do I give myself the most options to choose what to do with my time, where to do it, and with whom to do it with. So it's really, I think, about 3 different pieces of freedom. It's time freedom, financial freedom, and the freedom of thought. You can follow passion projects. So all of these different goals can really be solved from passive investing. Passive investing and generating revenue from passive investing and passive income. So what we're going to talk about is, what is passive income? So passive income is investing with the intention of generating income without the need for ongoing effort. And there's many kinds of passive income. Some that you probably are most familiar with are publicly traded. And this is what we can see in mutual funds, real estate investment trusts, REITs, as well as dividend stocks. These are, there's a lot of content out about them. You'll see a lot of articles and publications. and they're publicly traded instruments that can generate passive income for you. And then on the other side, on more the private offerings, we see a lot more peer-to-peer lending, crowdfunding, and then the real estate syndications, which again is the space that I play a lot in and where I've kind of shifted my own investing over the years as I've continued to educate myself. And all of these generate passive income. And the one thing I would add is that few of them are as time tested as investing in real estate. Real estate really offers a great reward relative to risk. And this is what we just like to keep in mind as we're looking for those vehicles that are most efficient for our hard-earned money so that we can get to our goals quickest and, conservative, I don't know if it's a great word, but as risk adverse as possible relative to the return. So looking at that a little bit further, I'd love to dive into why I chose real estate, why I focus on real estate. And to be perfectly frank, it's not just about me. 90% of the world's millionaires were created by investing in real estate. And I can say that I'm one of them. Real estate made me a millionaire, made my husband a millionaire. It's really set us up for success. And because of that, I want to educate other individuals and share what I've learned. I didn't come from a real estate family. I've learned this over the years, and you can too. So some of the great things about real estate, as I mentioned, the reward relative to risk, which we can see in the chart to the right here, we're really honing into it's lower risk, but it's higher reward. And we can get this lower risk and higher reward because of all the factors that come into play with this asset. With real estate, we can use leverage. You're probably familiar with it. If you have a primary home, you use leverage and the bank loans you say 80% of the value and you put down say 20% of the cost of that particular home. We use that same methodology when we're acquiring real estate from a commercial standpoint as well. Additionally, we have cash flow. So when we have residents that live in units, or if we're talking a commercial space, perhaps it's a office building, you have leases and people are paying cash flow for that. So we have this ongoing consistent income source that then is used to not only give the owner cash flow, but it also is used to pay down the debt. So you get debt amortization, which means each month when that mortgage payment is being paid, we are growing the equity in that particular property. So that's another way that we're able to extract value and gain value on it because the residents, the leaseholders, are paying down that debt and increasing the equity. Another great benefit we hear about in real estate is tax depreciation. When we're talking about multifamily specifically, the government is not in the business to provide housing, unfortunately, or fortunately. So in order to incentivize private individuals to buy housing, we get a lot of favorable tax treatments. Part of this we get through doing what's called a cost segregation analysis, where we can go in and identify all the fittings and fixtures in a particular building, the flooring, the countertops, and we can depreciate the value of that over a certain period of time. And over the last several years, we've been able to do what's called bonus depreciation, where we are able to accelerate all of that depreciation very early on. So we get extremely favorable tax benefit or paper loss in the early years of owning a particular property. There's a lot of details in here. I'm trying to keep this relatively high level, but we can go into the additional conversation either in the Q&A or after the fact. If you want to set up a call, we can do that as well. The next piece is appreciation. So we have kind of two different kinds of appreciation. We've got market appreciation, which traditionally keeps up with inflation, which is normally, right, historically 2 to 3%. And then we also have what's called value add appreciation or forced appreciation. This is when we as owner operators identify properties or go into a particular property. We add operational efficiencies. Perhaps there's more labor that's needed. We have too many maintenance individuals or too many individuals in the leasing office. And we can reduce expenses from that perspective. Or there is water is a big thing. if water is being paid for by the owner of the particular property and there's leaks throughout the property, that of course makes the water expense go up. So we can go in and put low flow toilets, do different type of things on the water to make it more efficient, which will reduce the expenses. And then the other side is to renovate units to bring them up to market standard so that we can then bring rental rates up to market level, as well as drive additional revenue through additional services at the property, or maybe trash valet, so residents don't have to walk their trash to the trash can. They can have it right outside of their front door. It's a more home type experience there. So those are value appreciation. I also love the fact that when we're talking commercial real estate, whether it be industrial, multifamily, office space, it's based on numbers. The valuation is based on numbers. So the net operating income, and this is where those operational efficiencies and the renovations and upgrades in order to bring rents to market rate are so important. The more we can increase the net operating income of the property, the higher the value goes up. So as opposed to a single family home that is valued at what your neighbors or somebody else very close to you has sold for in the last 3 to 6 months, in commercial multifamily or in commercial properties, it's based on your net operating income. So we have so much more control over the value of a particular property and being able to execute business plans for it. And then the final one I want to touch on here for, why real estate's awesome is that it's a tangible asset. So we're going to get the most optimal value out of property when it's fully leased up and we're operating really efficiently. But heaven forbid there's a big fire, or we just had a hurricane in Florida, bad example, but the building itself is a tangible asset. It is still, there's value in the building itself, even beyond the leases in the business that's being operated in it. The land that it's on is a value, there's value to the land. So that goes to the point of being able to mitigate some of those downside risks. You don't want to own a building that's necessarily empty. It's not optimal. But it is one of the great things that it is a tangible asset that has value in and of itself. So that's, again, talking about real estate and why, what I love so much and what's great about real estate. I want to dive in a little bit more on the passive income sources in real estate specifically that we talked about in the earlier slide. So the real estate investment trust, or REITs, are essentially, they're companies that own and operate income producing real estate that trade shares on the stock market. So something upsides here is, yeah, you are investing in real estate. It has a really low barrier to entry. It's really the cost of the stock. So it's a low barrier to entry, but you have very little control and very little transparency in what is being invested in, beyond the sector that's being invested in. From a diversification perspective, you've got moderate diversification within the portfolio because it's spread across multiple units. However, it is all still one sector. So that's something to keep in mind there. Your liquidity, I'll talk on liquidity. Liquidity is very high because just like stocks, you can wake up tomorrow morning and decide you want to sell it, and your money's back in your brokerage account and then subsequently transferred to your savings account. But where we see some of the downsides when we're kind of evaluating different opportunities in real estate is the returns. So the returns are typically around that 11 to 13%. And, compared to the stock market, that's decent. But it is very volatile because it is part of the stock market, even though you're investing in actual assets through this intermediary. There are higher fees and lower leverage. Tax benefits, it's very little to none. You personally will not receive the tax benefits. They're being done as part of the portfolio before you buy the actual stock. So it's being done on the operator side. And then you do have stable dividend payments. So that's how you would be compensated or receive that passive income. The next one I want to speak to is crowdfunding. Crowdfunding, and then the next one we'll talk about syndications, are fairly similar. The big difference here is that on crowdfunding crowdfunding is typically done on an online platform where you have dozens of investors that come together to buy a particular asset, a particular income producing asset. The barrier to entry is slightly higher as they'll have different minimum investments, maybe 5,000. So it's not super high, but a little more 5,000. As a passive investor, you don't have any control in it, which is normal when you're passively investing. And you have moderate level of transparency because you do typically know which property you're investing in, but you don't necessarily have direct communication with the operating partners to be able to get access to additional due diligence documents or underwriting that you might want to see. Portfolio diversification, it's low. It's going to be the same when we talk about syndications because you're typically investing in one, maybe two different properties. So it is low. Where you get diversification is you're going to be diversifying into multiple assets over time. And then from a liquidity perspective, you're typically in a 3 to 7 year hold period. Your risk is low to moderate. The great thing here is that you can get at, what you're investing in. So you can at least look at the market to make sure it's a growth market or that you've got a job growth. People are moving to that particular area. You can have an idea of what market rents are if you want to go down to that level. And then the returns are slightly higher than what we saw on the REITs, 13 to 15%. Lower fees, and we do have higher leverage from a crowdsourcing perspective. It's totally decoupled from the stock market, so your volatility is much lower. Real estate is a kind of a lag to what you see in the financial markets. So that's something to always keep in mind, that it is less volatile, with the exception, obviously, of 2008 was a unique set of circumstances, which is totally different than what we're going into this current period of economic uncertainty. And we can talk more about that in the Q&A if you'd like. Tax benefits are low because it is being done on the crowdsource on the online platform. And then passive income, it really varies deal by deal, but that is very transparent when you're investing in the deal of what the expectations are. And then the third topic that I want to talk about from a real estate perspective is syndications. And again, full transparency, this is what I've been focused on the last several years. This is where I'm spending a lot of my time and energy. And you'll notice a lot of similarities to crowdfunding, where it is dozens of investors that come together to pool their resources in order to acquire a income producing asset. What is different is that it is more personal. It is more one-on-one. As an investor in one of our deals, you have access to the operators. You have access to full underwriting if you want to see it. You have access to that information. So I'm regularly texting with my investors or receiving emails and going back and forth. The barrier to entry is usually higher because we are typically raising millions of dollars. So you will see that the barrier to entry, you're usually talking 25, 50, some deals are $100,000 minimum investments, but it's all conversation and as we look at different deals. The level of control, again, as a passive investor, you have no control over it. Same thing with crowdsourcing and REITs, but your transparency is extremely high. You have total control over what you ask. And with any operator, you should feel like you are getting honest feedback and honest answers, and that the operators are available to answer your questions. So that is very important when you start talking to different operators, to make sure that you find one that has open lines of communication. Portfolio diversification, just like we talked about in crowdfunding, you're investing in one, maybe two deals in a particular syndication. So the diversification really comes when you start investing in multiple deals. Liquidity, it's a little bit shorter of a hold period. What we've seen is more like 3 to 5 years. There are ways to get out of things mid transaction. But I tell all my investors that you don't really want to, because you'll be selling your share at a discount. So you need to go in with the mindset that you're holding for 3 to 5 years so that you get the full returns. And then from risk, it's really low to moderate from a risk perspective, because again, with real estate and buying an income producing asset, we have historicals for the particular property. We can look at the market and market performance. We're looking at migration trends and job growth. We're able to forecast out these different components and then hold proper reserves so that we can mitigate the risk side of it. And returns are higher. So in syndications, we're seeing usually around 18 to 20% returns, and those are total average returns over a 3 to 5 year period. And we'll talk a little bit more about how this looks when we think about a path to financial freedom in 10 years. And then the tax benefits. So when you invest in a syndication, it's extremely similar to as if you were buying an investment property on your own. If you're buying a single family home, you are going to receive what's called a K-1 tax document every year. And that is what's going to have the depreciation benefit, or the paper loss, if you will, that you will be able to use to help offset other passive income. So you get the benefit of the tax benefits for the thing. So that's great when you're investing through a private offering like this. And then from a passive income perspective, it varies by deal, but generally what we see is the first 3 to 12 months, there's very little distributions as we're stabilizing an asset. And then you start to see those returns in close to it 8% mark, and then increasing over the hold period until we get to a sale. So that was a lot of information. We're going to transition a bit here and start talking about what financial freedom kind of means. And excuse me, before we go on to that, we're going to transition a little bit more about multifamily and why I feel so confident about the future of multifamily and what we're set up from a market perspective. So supply and demand is a huge factor when we're really talking about anything in pricing and investing. We have, from a US perspective, quite frankly, a severe shortage in housing. We keep hearing about the affordability crisis. This is really, the root cause is the lack of supply. We are short some 4.3 million housing units by the year 2035. And this graph here is really the top 10 locations of where we need housing units. And you'll see it's predominantly the Southeast, or 50-50, the Southeast, and then spread around the rest of the United States, with the largest number of units needed in Texas and in Florida. And we're not building enough to even meet this need. And this stems all the way back from the 2008 housing crisis, when the fundamentals in the real estate market, it was really the lending that everything just kind of fell out. The demand for housing starts really screeched to a halt, which then translated into individuals who might have went into their trades, stopped going to trade school. You didn't then have apprentices. So then when you started to try to do housing starts, you had a lot of companies that also left the home building industry. So we were behind the 8 ball coming back out of that. And even to this day, and COVID exacerbated even further, that we're not seeing the labor. The cost of construction is continually increasing. So the ability to build affordable housing continues to be a challenge. When I drive around, I see all these huge new apartment complexes going up. Those are what we call Class A apartment complexes. Those are really nice apartments. People are paying $2,000 a night. That's not affordable housing. So that is one thing that when we're looking at potential properties to purchase, we're looking at those that are going to help solve that need. The other side of this is the demand. Myself, my partners, we predominantly focus on the Southeast, Florida, Georgia, and Texas, as I had mentioned. When we think about the migration patterns, those states are taking a lot of a lot of people coming into these markets. They're also coming in with a fair bit of income. So we're seeing the income in these states also going up. We are favorable business environments. We have basically no individual income tax. So it's a very favorable place for people to move. And then as we have the millennial generation continue to come into prime, they're in prime home buying type housing formation age. So we continue to see more demand from an apartment perspective because of those formations. Ooh. So the next thing I want to just kind of call out is a couple verbatims or quotes that we're seeing in the market. Motley Fool just put a piece out not long ago that really spoke to real estate's long been a playground for the rich and well-connected. I mentioned early 90% of millionaires were created by real estate, and that it's probably the best investment in modern history. I will nod to this, that we're not all in real estate to just be rich. It's really about unlocking options and that freedom. To me, that's the root cause of why I do what I do, and why I'm so passionate about helping other people, is because it's unlocking the optionality. And then just last week, Willie Walker, who's the CEO and chairman of Walker and Dunlop, he was saying that multifamily is a great place to be investing right now. And again, it goes back to the supply and demand. We also have very strong lending markets when we're looking at multifamily. So let's transition to kind of, as we think about financial freedom, what it means to you. It means something to everybody different. It could be that you want to spend your time volunteering, maybe traveling, maybe volunteering overseas. Maybe you want to hike the El Camino in Spain. That sounds cool. Or community involvement, but you want time to be able to do kind of what you want to do and how you want to spend it. If you're a kindred spirit of me, you might want to sail around the world. That's one of my ultimate goals. So keep an eye on what I'm doing, and that's where I want to go. So let's talk a little bit about how we can get there, and the 10-year path to financial freedom. So we first have to lay out some assumptions. And one of these assumptions is that you have the ability to invest $50,000 a year annually for the next 10 years. That might seem like a lot. I will tell you that my husband and I, about 5 years ago, we made the commitment to live on one income, which gave us more than this $50,000 a year to invest. It is, and this is where I go, everybody has the opportunity, but it takes choices. You can't have everything, but you have to choose what you want. And this is really taking a critical look at your life, making sure your spending is aligned with your values and prioritizing what you want to prioritize. So these assumptions are: you're investing $50,000 a month annually. We're investing in deals that have a 2x equity multiple, which in layman's terms means that it's doubling your money every 5 years in this example, so the 5-year hold period, and that we see an 8% annual cash flow. Now you might be going, wow, you're doubling my money every 5 years. That seems a bit aggressive, right? The reality is that the deals that we're doing, we are doing that. These two pictures I have here are 2 deals that we've closed in the last 12 months. One of them was a 2.15 equity multiple. The one on the other side was a 2.09 equity multiple. These deals are out there. We are still underwriting deals, even with these higher interest rates, all being considered in the underwriting. So this is a realistic example of how to get there. It's all about consistent action over a period of time to achieve your financial freedom. So the graph on the right, I hope it's your right, the chart that is there, where it says start in the bottom, this is where we're really starting. And that's really your year one kind of column. You're going to start by investing $50,000 and then over the course of year one, you're collecting that 8% cash flow, just kind of in a bucket. And in year 2, you're going to put a new $50,000 investment in a different deal, along with the 8% cash flow, which was $4,000, into this other deal. And you're going to rinse and repeat that through the course of the 10 years. 3rd year, you're putting a new $50,000 in, you're putting the 8% cash flow, which is the 8,000. You're going to do this over the course of the time. In year 6, we start to see those initial deals that have a 5-year hold period sell. And that's when you get your 2x equity multiple, the balance of it, less the cash flow. That's when you get that. You're going to take all of that and reinvest it into another deal. And this is where the diversification comes in, because these are all different deals. They can be different deals with the same operator. They can be different deals with different operators. They can be different deals, some in multifamily, some in industrial. You can diversify this portfolio all within real estate, but in different sectors or different operators. And you're going to do this over the course of 10 years. And when you hit at the end of 10 years, you will have built a passive income stream of $82,000. So provided you can live on $82,000 a year, you will have achieved financial freedom. And if you want to live on more than 82, well, then just put more money in every year. If you can live on less than 82, you can put in less every year. The concept is the exact same with depending on how much powder you can put in, if you will. So I love this. I do have a poll that I wanted to ask. So how many of you guys in the audience are familiar with the safe withdrawal rate when we're talking about retirement accounts? There should be a poll that came up on the screen. Go ahead and click whether you are, you're not, or you're like, I don't know what the heck she's even talking about anymore. That'd be great, because it just kind of love to kind of think about how we compared these. Okay, I'm going to go ahead and get the, it looks like we have 8 out of 11. Let's give it another 3, 2, 1. Okay, let's go ahead and close this. So I'll share the results. So great, 6 out of 9 of you know what the heck I'm talking about, which is great. A couple of you don't. That's totally fine. And some totally fine. Tim, is that you? I don't know what the heck she's talking about. I'm just kidding. So what the safe withdrawal rate is, for those of you that aren't as familiar, is within retirement accounts, there is, I'm not going to call out the actual study, but basically you save up in your retirement accounts, whether it be 401k, IRAs, whatever your tax deferred retirement accounts are. It could be brokerage accounts as well. And provided you can live off 3 to 4% of that total value, you can withdraw that without depleting the balance for the remainder of your life. There's like a 98%, it changes whether it's 3 or 4% remainder of your life. In this particular example, this represents an 8% return on investment. That $82,000 is an 8% return on investment. And the beauty with this is, as those deals are turning, if you keep reinvesting, you can see that that annual income goes up over time. So I hope that makes sense. It's a lot of information, really compact. I've gone through a lot here. So you may be wondering, what is, what now? What do you do now? This is what I would just ask you is obviously absorb the information and commit to taking action. Whatever action that is for you, commit to taking action. Educate yourself. I mentioned early on, I did not come from a family that was real estate investors. This is all information that I've really taken it upon myself to learn and grow and be curious about over the last decade or so. Really got active about 5 years ago. There's numerous podcasts, webinars. Spend some time meeting with operators that you connect with. You can start with me and then find some other operators. I can point you in the direction of some operators so you can start to have conversations to start to learn more. And review sample offerings so that you have an idea of how these deals are presented, and you can start to get more comfortable with what you're looking for. The other thing, as I mentioned, be in passive income. People are always like, how do I make money without spending any money? Well, you can't. Well, you can if you put a lot of sweat equity in it, but when you're a passive investor, you need to have capital to invest. So if you don't already have money allocated for investments like this or other investments, you need to start looking at your personal finances to make sure that you are growing the gap between your income and your expenses, and you're allocating that gap to invest in passive income sources or other types of retirement funds so that you can achieve financial freedom. And then it's super important that you perform due diligence on the operators and their experience, their values, their communication styles. And then, of course, when potential deals come up, you're going to need to do the same thing with that. Perform due diligence on properties and their offerings. And then once you've done all that due diligence, it may still be scary, but you need to invest. You need to pull the trigger and take action and put it into place. The surest way to failure is lack of action. So that is my advice of kind of like, what's now, laying the foundation of how you can achieve financial freedom in 10 years or less. So that is really the content. I will go ahead and open it up to questions. On the screen here, you are welcome to set up a call with me or follow me on LinkedIn, where I'm super active. And I'm a thought partner. I love to be a resource. So feel free to reach out, and I look forward to answering what questions everybody has. Let's see, do we have any questions out there? And if there's no questions, we can just go into conversation too. Let's see, is everybody muted? Let's see if I can unmute. Oh, I got something in the Q&A. Go ahead and open that up. Okay, thanks, Adam, for the question. So the question is, how are higher interest rates affecting things? Great question. They are certainly affecting things. What we are doing, so when we're looking at new deals, we obviously are getting quotes for lending, so we have an idea of what those interest rates are. And we're seeing interest rates, depending on the type of mortgage product that we're getting, anywhere from 5.5% to upwards to 5.5% to 80, 5.5% to 8% in some of the deals that we are currently underwriting. And we're underwriting it. If the deal doesn't pencil with a higher interest rate, then it's not a deal for us, and we'll pass on it. What we do to put into place to mitigate the risk as we're in this environment where it looks like interest rates are continuing to take the increase as inflation continues to kind of be high, is that we really have two different options. We look at buying what's called a rate cap, where we can pay upfront for insurance to mitigate how high the interest rate can go after we close on a property. For many of our properties, we're using what's called a bridge debt. Because they're big value add and we're going in and we're spending millions of dollars to renovate, we don't typically go into what would be the equivalent of a 30-year product in a single family. We go into what's called bridge, so it's more adjustable rate. But we can buy a rate cap, which will say that the interest rate cannot go 1.5% or 2% above the interest rate at purchase. So that is one way we mitigate our risk. And then, of course, we underwrite to that higher amount to ensure that we can still achieve the returns and the projections. The other thing is that we actually just came across a new product. It's another bridge debt, but it's a fixed product. The rate is higher initially, but it is a fixed interest rate, which again mitigates the risk there. Great question. And feel free to unmute. I think you guys should all be able to unmute now. So feel free to unmute if you want to ask your question verbally, or you can put it in the chat as well. Are you all just so astonished that you can retire in 10 years if you want to? Keep in mind, that was starting from 0, so you might already be on your way. Is everybody able to unmute if you wanted to? All right. It almost looks like Scott's talking, but he's muted. Maybe I can hit ask to unmute. Hey, Tim, can you unmute and tell me if you can talk?
Can you hear me?
Oh, I can hear you, Carla. Yes.
I unmuted.
Thank you. Well, that's all the content I have. So if nobody has any questions, everybody can have the gift of time.
That was a great presentation, really informative and so awesome. You shared your personal story, so that was wonderful to hear. A lot of people will benefit from this.
Thank you, Carla. It's very kind. Super passionate about it. So
it shows. That's great.
Awesome. Well, have a great night, everyone. Like I said, feel free to reach out if you have any questions. I'll look forward to speaking to each and every one of you again soon. Take care.
Thank you so much.
Oh, I might have got a question. Hold on. Let's see. Natalia, I got a question. How much appreciation was from market and how much was from value add in those two examples? Good question. I don't have the exact percentages, but what I will tell you is the majority of it is from value add. Again, when we talk about market appreciation and we're putting that in our underwriting, market appreciation is typically 2, maybe 3% a year. The remainder is value add. So we are finding property. One of those properties we actually acquired 100% vacant. We went in and put $4 million. Well, we're in the process of putting $4 million in it. We're getting the last of the renovated units back this month, and then we'll be fully stabilized in the next 60 days. So it is predominantly the value add play. The other particular asset that I showed there, we acquired it, I think it was 98% occupancy when we acquired the property, but it was about $160 a month below market rents, predominantly because there was operational efficiencies, but then the units hadn't been upgraded to market standard. So we're putting, I believe that property, we're putting about $1.5 million in and renovating the units so that we can bring the rents up to market rent and increase the net operating income. So we do not bet on market appreciation. The last couple of years, that has been fantastic, but we do not put that in our underwriting as the big driver. It's really the value add play. And then I got another question. So Adam asked about non-accredited deals coming up. So I want to first explain accredited, non-accredited, because I don't know everybody that's on the call background. So typically when we're doing real estate syndication deals, what you might see on LinkedIn or advertised, they're only open to accredited investors. We have to adhere to Security and Exchange Commission regulations. And if we're going to advertise them, they're only open to accredited investors. An accredited investor is an individual that has a net worth of $1 million or more, excluding their primary residence, or income of $200,000 or more for the last 2 years, with the expectation to achieve it this year as well, as an individual, or 300,000 as a couple. So that's the definition of both. The question about non-accredited deals, we are working on some deals that we have the intention of making non-accredited initially. With those deals for individuals that we have a pre-existing relationship with, they would be available to invest in them. If somebody that we haven't had any conversations previously, understanding investing background, we would need to first have those conversations and have a certain period of time pass before we are able to offer those as investment offerings. But yes, we are working on we have a good few deals that we are really pursuing at this point in time. So feel free to reach back out to me, and we can talk about it a little more direct. Great. Thank you everyone for your time this evening. I'll look forward to speaking again soon, and I appreciate your time. Take care, everyone.